Hey, it's Spencer again. Welcome back to the Friday Five. I actually shot a video last week, but now have realized that some CRM technical difficulties probably led to maybe 3 out of lots of you getting it. So I don't know. That video exists if for some reason you want to go back and watch it. It's on my YouTube page. Jump into mortgage rates. Number one, national averages from Mortgage News Daily. VA 30-year fixed 6.04%. FHA 30-year fixed 6.03%. Conventional 30-year fixed 6.32%. Conventional 15-year fixed 5.82%. And then that conventional 7-year ARM 6.01%. So most rates, except for the 15-year, over 6% again. There's really just not a lot of economic data out there, but with the government shutdown, for mortgage rates to really move much. And the small direction that we have seen them move has had a lot to do with what Chair Powell had to say back at the last Fed meeting about potentially there not being another cut in December. And then this week, there was a jobs report that came out from ADP that was a little bit better than expected, and that led to mortgage rates going up a little bit as well. So till there is more economic data, I don't know that we're going to see any type of big movement in mortgage rates. Number two, I want to show you this. I cut out the agent information, but I want to show you this ad that I saw on Facebook for a property listing. And as you'll see, the seller is offering a Tesla up to $50,000 value to the buyer of their home. So this is an interesting marketing strategy, but here's what the conventional Fannie Mae guidelines have to say about this situation. A seller can, in general, provide what's called a seller concession or seller assist to the buyer, but that concession has to be applied to the buyer's closing costs and prepaid expenses. This type of concession, where you're giving someone a Tesla, is what's considered an inducement to buy, which is not an allowable seller concession. So in this case, if it occurs, then the conventional guidelines say that for mortgage purposes, the purchase price has to be reduced by the value of the car. So if the house sells for $800,000 and the car value that they're receiving from the seller, that the buyer's receiving is $50,000, then that knocks the sales price down to $750 for the actual real estate, because the assumption is, well, $50,000 of the purchase price is for the car. So the same is true as well if the seller offers a vacation or furniture or any other material item to the buyer that has value. Once in a while, you will see a transaction where the house is sold furnished, or they'll include the patio furniture as part of the agreement, and then the lender always has to get something that says no value is given to that item. And usually it's a smaller amount, so that usually flies. $50,000 Tesla, probably not the same. So real estate agents, this is very much a creative marketing strategy. I love seeing you guys try to find a way to sell those homes, but it's probably not one that's going to help you in the long run. Number three, I want to share with everyone a theory that I have related, and there's no data to support this, so you'll just have to whimsically listen to me talk. But this is a theory that I have on home appreciation nationally, and something that has contributed to it. So obviously, home prices have significantly appreciated over the past couple years. A lot of that has to do with the supply and demand. There just is not enough supply of house to meet the demand, and people are bidding against each other, and they're pushing prices up. Some of that also has to do with the cost of materials to build a similar home, and then just general inflation across the country as well. But here's my theory that I think has contributed to home price appreciation or home value appreciation. I believe that the overall housing stock nationally has allowed or encouraged money to be reinvested in real estate, which also has pushed the value up. So here's what this looks like. I've owned my home for 10 years. If when I bought it, I paid $400,000 and I put 10% down, I owe $360,000. If it's worth $410,000, I'm probably not going to put a $50,000 new kitchen in my house, because I may actually be over-invested in my house. And maybe I don't care because it's lifestyle, but there's some people that won't do that. They're not going to over-invest in their house. But if my house is worth $500,000 and I've paid my mortgage down to $320 and I have $180,000 in equity, I may put a $50,000 new kitchen in. I may put fresh flooring in the whole house. I may repaint it, do siding, like et cetera, just lots of improvements to my house because I feel comfortable doing it because I have so much equity based on some of the appreciation that we've already seen. I also think for a long-term investor, I own 2 rentals here in Emmaus. I was good with doing some pretty significant renovations in between tenants because I knew I had a ton of equity there. So I improved my stock of real estate just because it was worth more and I was comfortable doing that. And I think the same thing occurs, or the same thing applies, I should say, for flippers. If you go to a sheriff sale, like I don't go, but I have buddies that are investors, and they say the sheriff sales are jammed with people. There are flippers that will buy anything right now in any condition and renovate it because they're pretty confident that they can resell it at a profit. So I think you take all this together, certainly values have just gone up, supply and demand, cost of construction, and inflation. But I think then you add in the fact that people have spent money to improve the real estate stock nationally, and I think that has led to price appreciation too. I don't know if that helps you in any way, but I think hopefully that's helped our country. We have nicer real estate across the board because people haven't reinvested in it. Number 4, this is a question from a viewer. Somebody reached out to me and said, on an FHA loan, why isn't the loan amount equal to the purchase price minus the down payment amount? It's always higher. So on FHA loans, there's a base loan amount, and that's always the purchase price minus the down payment. So if it's $200,000 purchase price, you put 3.5% down, that's $7,000. Your base loan amount is $193,000. But FHA also charges upfront mortgage insurance premium, which is UPMIP, equal to 1.75% of the base loan amount. So that upfront mortgage insurance premium, a buyer can either pay it in cash out of pocket at closing as part of one of their closing costs, or they can finance it in on top of their base loan amount. Most FHA buyers don't have a surplus of funds, so most finance that on top of their base loan amount, that upfront mortgage insurance premium. So in that $200,000 scenario, $193,000 base loan amount with $7,000 down payment, then the upfront mortgage insurance is $3,377.50. So the total loan amount at the end is that $193,000 plus the $3,377. You have to pay the 50 cents out of pocket. They won't finance a fraction of a dollar. But so then the end loan amount ends up being $196,377. So hopefully that helps explain. And I think even some real estate agents struggle with this when they write an agreement of sale for an FHA customer and they have to fill out the mortgage contingency box. Like, why doesn't it match, or why doesn't it make sense when you do the math? Number 5, the quote of the week from James Clear. This is from his weekly newsletter. Earning more money increases freedom. Spending less than you earn reduces stress. So take that for what it's worth. But if you want to live a stress-free life, have some financial margin. Thanks for watching. I hope you have a great weekend. If I can help you in any way, I truly mean that, please reach out.